Welcome, everyone. In the Canadian tax system, there are a couple of really powerful tools that can turn what are often very significant life costs into substantial tax savings. I'm talking about the medical expense and the disability tax credits. And today, we're going to dissect exactly how they work. So, to really get a handle on this, we're not just going to talk theory. We need to look at a real-world application. And this really is the central question, isn't it? How can these huge expenses, things like medical bills, accessibility renovations, disability care, how can they actually be transformed into major tax savings? Well, we're going to answer that by walking through a detailed case study that really puts the theory into practice. Okay, let's dive right in. All right, so to understand the mechanics here, we first need a subject for our case study. So let's meet our taxpayer, Clarice. Clarice's situation is a perfect illustration for us. Okay, so she has a solid net income, right? Over $132,000. But, and this is key, she is the sole earner for her family of four. On top of that, her 13-year-old son qualifies for the disability tax credit, and the family is facing some pretty major medical and accessibility costs. You can see how this presents a really substantial tax challenge, one that these credits are specifically designed to address. So let's establish our baseline. Just based on her income alone, Clarice's initial federal tax bill is $25,206. That's our starting point. Our goal now is to see how a strategic application of these non-refundable tax credits can systematically and really significantly bring this number down. The first tool we're going to apply, and it's an incredibly impactful one, is the Disability Tax Credit, or the DTC. Now, in this case, it's for Clarice's son, who has been certified by a medical practitioner as qualifying for it. Now, the purpose of the DTC is really important to understand. It's a non-refundable credit. What does that mean? Well, you can think of it like a coupon. It can reduce your tax bill, maybe even all the way down to zero, but it's not going to result in a cash refund if you have extra. It's specifically designed to give some tax relief for those unavoidable, often substantial costs that come with a severe and prolonged impairment. And here's where the details of the structure are so important. Because Clarice's son is only 13, he qualifies for not just the base DTC amount, which is nearly 10 grand, but also the supplement for those under 18. That adds almost another $6,000. You put those together, and it substantially increases the potential credit base we have to work with. So this is absolutely the crucial point. The credit is transferable. I mean, think about it. Clarice's son has no income of his own, so he can't possibly use this valuable credit. The tax code recognizes this and allows the full value of his DTC and that supplement to be transferred directly to Clarice, his supporting parent. This way the family can actually realize the tax benefit. It's a huge deal. Okay, next up, let's look at the Medical Expense Tax Credit, or the METC. Now, this one is a bit more complex. It involves a specific formula, so let's break that down piece by piece. At first glance, this formula, well, it looks a bit abstract, doesn't it? But the logic behind it is actually pretty straightforward. You take your total eligible medical expenses, we'll call that B, and then you subtract an income-based threshold, which is C. What's left over is the base for your credit. So let's dig into what each of those variables really means. Let's start with B. This is just the grand total of all your eligible medical costs. For Clarice, this B amount is like a big pool that includes qualifying costs she's paid for herself, for her husband, and for both of her children. It's not just for one person, it's for the entire immediate family unit. Okay, now for C, the income threshold. The government's logic here is essentially that everyone is expected to cover a certain amount of their own medical costs. So the tax credit doesn't kick in from the very first dollar you spend, it only applies to the expenses that rise above this threshold. That's what that B minus C calculation represents. It's the portion of your expenses that you actually get credit for. So how do we figure out that threshold C? Well, you calculate two values, and then you just take the lesser of the two. The first is 3% of your net income. The second is a fixed annual amount that the government sets. So for Clarice, 3% of her income is almost $4,000. But the fixed amount is lower. It's $2,759. So that's her threshold. That's the number we'll use. Now listen up, because this is a really critical insight for tax planning, and it's a fantastic example of how different credits can interact with each other. The legislation is actually very clear. Certain expenses can be claimed under more than one credit category. And no, this isn't some loophole. It's a feature of the system, and it's designed to provide enhanced relief for specific types of major costs. Clarice's situation is the perfect example of this in action. She spent $12,500 on wheelchair ramps to make her home accessible for her son. This single expense, this one cost, qualifies for both the home accessibility tax credit and as an eligible medical expense. This is amazing. It means that same $12,500 is going to be used in two separate credit calculations, which effectively maximizes its tax-saving power. All right, so we've established the rules, we've gone through the key concepts. Now we can assemble all of Clarice's eligible non-refundable tax credits and actually calculate their total value. This is where the rubber meets the road. Okay, so let's pull everything together. This is basically our checklist of all the credit bases we're going to use. You've got your standard ones, right? The basic personal amount. You've got credits for her role as the sole earner, like the spousal amount. And then, of course, you've got the ones that are very specific to her family situation, the transfer DTC, the caregiver credit, and the two we just went into detail on, the home accessibility and the medical expense credits. Now let's apply that METC formula directly to Clarice's numbers. Remember B, her total medical expenses? That's her practitioner fees plus that double-dipping ramped cost, for a total of $24,665. Then we subtract her threshold C, which was $2,759. That leaves us with a final base amount for her medical expense tax credit of $21,906. And now for the final calculation. We just sum up the base amounts from our entire checklist. You add them all up, and the total comes to just under $90,000. Then we apply the lowest federal tax rate, which is 15%. And that gives us our final number, a total non-refundable tax credit of $13,464. Now this is the actual dollar amount that is going to be subtracted directly from her tax bill. So, after all that math, what does this actually mean for Clarice's bottom line? Let's look at the final resolution. The result is, well, it's truly dramatic. Clarice's initial federal tax bill was over $25,000. We subtract her total credit of over $13,000, and her final tax payable is now just $11,742. That's a reduction of 53%. The strategic application of these credits has literally cut her federal tax payable by more than half. That is the power of understanding these rules. And this chart breaks down exactly where all those savings came from. Now, while the standard credits make up a pretty big piece of the pie, just look at this. A combined 58%. That's more than half of her total tax relief comes directly from the disability, the medical, and the accessibility credits that we've been focusing on today. It's incredible. You know, this case study really demonstrates precisely why a deep understanding of the tax system is so crucial. It's not just about compliance, about filing your taxes correctly. It's about actively managing your financial well-being. Knowing the rules allows you to access the support that the system is literally designed to provide. And that really leaves you with a question to think about.